As featured in CNN Business Before the Bell newsletter, the specter of a regional banking crisis looms large once again, triggering a sense of déjà vu among investors. Nearly a year has passed since the collapse of 3 U.S. regional lenders, prompting urgent measures from financial institutions and regulators to avert a full-blown banking catastrophe. Now, fears are resurfacing, echoing past anxieties. However, unlike the previous crisis, which centered on interest rate risks, the current predicament revolves around the $20 trillion commercial real estate market. What's unfolding? Decades of expansion fueled by low interest rates and accessible credit have come to a halt as commercial real estate faces unprecedented challenges. Valuations of office and retail properties have plummeted in the wake of the pandemic, reshaping where people live, work, and shop. Moreover, the Federal Reserve's efforts to combat inflation through interest rate hikes have exacerbated the plight of this credit-dependent sector. Regional banks, in particular, find themselves in a precarious position. Holding approximately $2.7 trillion in commercial real estate loans, the vast majority of which, about 80%, are managed by smaller regional banks, they face significant hurdles in the current environment. With a substantial portion of these loans set to mature, regional banks may encounter difficulties in loan recovery. Data from TREP suggests that over $2.2 trillion in loans are due between now and the end of 2027. Last week, concerns were further fueled when New York Community Bancorp, NYCB, reported a surprise loss of $252 million in the last quarter, a stark contrast to the $172 million profit recorded in the fourth quarter of 2022. The surge in loan losses, totaling $552 million, was largely attributed to expected losses on commercial real estate loans. Consequently, shares of NYCB plummeted nearly 20% over the past 5 trading sessions. The ripple effects extend beyond U.S. borders, with Japan's Aozora Bank citing bad loans tied to U.S. offices as a contributing factor to its projected annual loss of 28 billion yen, $190 million, last year. Similarly, Germany's Deutsche Bank quadrupled its allocation to absorb potential defaults on U.S. commercial real estate loans during the last quarter. The scenario has prompted some companies to offload valuable properties at bargain prices. For instance, the Canadian Public Pension Investment Board sold a 29% stake in an office block in Midtown Manhattan for just $1 after having initially invested $71 million in the building. The Financial Stability Oversight Council, featuring Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, and U.S. Securities and Exchange Commission Chair Gary Gensler, underscored commercial real estate as a significant potential financial risk in a report released last December. They warned that losses from a commercial real estate loan portfolio could spill over into the broader financial system, leading to a downward valuation spiral and reduced property tax revenues for municipalities. Concerns mount. As Treasury Secretary Yellen prepares to testify before the House Financial Services Committee about the aftermath of last year's regional banking crisis, she faces the daunting task of assuring lawmakers and the American public of the banking system's stability while acknowledging the real risks posed by a commercial real estate-driven crisis. Federal Reserve Chair Powell also addressed the issue during an appearance on CBS 60 Minutes Sunday evening. He acknowledged the challenges faced by smaller and regional banks with concentrated exposures in these areas and emphasized ongoing efforts to address the problem. While Powell expressed confidence that the crisis does not resemble past global financial crises, he cautioned that some banks may face closure or merger due to the prevailing circumstances, primarily affecting smaller institutions.